This is such a predicament of Cirrus research. I want to give you a quick summary on the recent Signals report. This is our asset allocation summary looking at stocks versus bonds, growth versus value, large versus small, etc. In this issue for August, the title is Compelling Discounts for Small Caps, Still Offset by Looming Slowdown. So let's get into this. Our key indicator, which is the Cirrus Tactical Size Premium Model, this reading, to sort of interpret this properly, when the reading is in the upper boundary here, this basically is telling you to overweight small caps. And when it's in the lower boundary here, it's telling us to overweight large caps. And so there's a conflict here because when we look at the valuations between small, large, and all the subcomponents, whether it's growth or value, what you'll find is a massive discount that's being seen in the small cap market. And so the investor, the long-term investor, is happy to say, hey, I'm not going to chase expensive assets. The problem with that is you've got a looming slowdown. It's quite possible that illiquid, riskier assets get left behind or cheap stocks get cheaper. So there is a cautionary note here. I will say, however, that to some degree, the outlook that we've got in terms of higher quality, the risk on innovation, these things should potentially favor a relative performance on small caps. So at this stage, even though the indicator is squarely larger companies, we think that the spread between small and large could end up being negligible at best over the next 6-12 months. And then something that's consistent here is that our style model, the Cirrus style oscillator, has also been in a growth camp for a while. Let me show you that. So this is our oscillator for style. When it's in the upper boundary, it is effectively a growth market. When it's in the lower boundaries, it's effectively a value-driven market. What's important or super interesting is that the reading that was favoring growth has just gone neutral. And to some degree, this may relate to do with the fact that maybe the inflation risk may be tapering a bit. In addition to that, industrial spending appears to be fairly stable, fairly constructive. So this rotation towards pure growth in the profit cycle that's peaking was sort of consistent with the general belief. This recent move to neutrality, we're going to watch closely. We'll keep an eye on this space. Take a look at the report. We hope you enjoy it. As always, with any questions, feel free to call us. Thank you.